Hello friends. Friends, in the last lecture we completed with share capital, and in this lecture we are going to start with a new topic, that is debentures. Right? Now if I talk of accounting treatment of debentures, it is more or less similar to what you have studied in share capital. So at the very outset of this chapter, I will request you all to go through all the videos of share capital thoroughly. Try to understand each and everything of share capital. If you have understood the share capital concepts, then doing debentures is very easy for you. Very easy. Right? Now, the first and the foremost question before us is, what are debentures? This is what we are going to discuss in this lecture. What are debentures? Right? Now, let's try to find out the answer to this. What are debentures? Friends, you take a loan from the bank. Right? Loan from bank. Consider yourself as a business person. Consider yourself as a businessman and you are in need of money. The first thing that will come to your mind is take a loan from bank. Isn't it? Take a loan from bank. The primary business of the bank is taking money who have surplus money and lending it to the people who are in need of it. So lending is loan. So as a businessman, you think that you are in need of money, you will take a loan from bank. As a student, if I say, when you are in need of money, whom you approach? You approach your parents. Your parents are your bank. Right? So what you do? You take a loan from bank. Clear? So when you take a loan from bank will charge interest from you. Bank will charge interest. Obviously, you are using the money of bank. If you are using the money of bank, the bank will charge interest on that money that is being used by a businessman. Right? So when you are taking loan from the bank will charge interest from you. This much I think all of you must be knowing, right? Very basics. Now, what is a debenture? If we talk of debenture, this is loan from public. So, what is a debenture? Debenture is about taking loan from public. You are not taking loan from the bank. Instead of taking loan from the bank, what you do, you take loan from the public, and against that loan, against the money that you have received from public, you will have to issue the receipts. In case of share capital also, when you are taking the money against issue of shares, you are issuing the receipts. That receipts are known as share application document. Share document, sorry. Right? In this case also, when you are taking a loan from public, you will issue an acknowledgement. You will issue an acknowledgement. Right? You will issue an acknowledgement for the payment that you have received from the public. The money that you have taken on loan from the public, you will issue an acknowledgement, and this acknowledgement is known as issue of debentures. This is debenture acknowledgement, and this is known as issue of debentures. So one thing is, you take a loan from the bank will charge interest. In debentures, you are not taking loan from the bank. Instead, you are taking loan from public. Right? So when you are taking the loan from the public, you received money from the public. then against that money that you have received, you will issue an acknowledgement. That acknowledgement is known as issue of debentures. That receipt is called a debenture receipt, a debenture document. Right? So the basic of debenture is clear, that it is a loan from public. Now you are using the money of public. They will give you this money free of cost. Was bank giving you its money free of cost? No, it's charging interest on that money. Similarly, if you are using the money of the public, you will have to pay interest to the public on these debentures. Pay interest on debentures. Right? So in case of debentures, you take loan from the public, you issue the acknowledgement. That acknowledgement is known as debenture document, and you have to pay interest on these debentures. On the loan taken from public, you will have to pay interest. Clear? Right? So this is what you call as debentures, that is loan from public, and against that loan you issue the acknowledgement. Right? That acknowledgement is known as debenture document. Then the people, write down, people to whom debentures are issued, debentures are issued are known as debenture holders. Right? So the people to whom the debentures are issued are known as debenture holders. And if you remember, in case of shares, the people to whom the shares were allotted were known as shareholders. Here you call it as debenture holders. Right? Now, interest on debentures will be paid at a predetermined rate. So what the interest you have to pay on the debentures, that will be a predetermined rate. Like in case of loan from the bank also, there are predetermined rates. Right? And moreover, when you are taking loan from the bank, the terms and conditions relating to repayment of loan principal amount plus the interest is decided at the time of taking the loan, at the very initial stage. Similarly, in debentures also, when you are issuing the debentures, first thing, the interest on debentures will be predetermined. Right? Second, terms and conditions relating to payment of principal plus interest are decided at the time of issue of debentures. Right? So whatever the terms and conditions are there related to the repayment of principal plus the payment of interest are decided at the time of issue of debentures and not later on. Right? Now, if you remember, in case of issue of shares, I told you the shareholders are the owners of the company. They have given the money, they are investing into the capital, they are the owners of the company. So can you say we are taking the money from shareholders also? We are taking the money from the debenture holders also. In both the cases, we are taking money from public. So that means even the debenture holders are the owners of the company? No. Debenture holders are not the owners of the company. Then why shareholders are called the owners of the company? Because they have invested in the shares, they are carrying higher risk of not getting an return, not getting a good return. They have invested their money, they are carrying a higher risk by investing in the shares, because the value of shares is very fluctuating. Here the debenture holders are going to get a fixed rate of interest, right? Shareholders who are investing in the shares, they are carrying a higher risk of their money being lost. They might not get their money returned, right? So that is why the people who are carrying the higher risk, they are the owners of the company. Debenture holders, we have taken the money from the public, right? And we have told them that we will pay you interest at a fixed rate. The terms and conditions are very clear at the time of issue of debentures. When you have to repay the debentures, when you have to repay the interest, all the terms or conditions are set at the very onset, right? But in case of shares, there are no terms and conditions related to returning the share money. Their money is in the business till the business is running, right? So their money is permanent. That is why they are called the owners. Debenture holders' money is not permanent. That money we have to return after a certain period of time as per the terms and conditions which are set at the time of issue of debentures. The money that is being raised from the shareholders is lifelong money, but the money that we are raising from the debenture holders is not lifelong. That is for a limited period of time. So what I can say is, debenture holders are the creditors of the firm, right? Are the creditors of the firm to whom money is to be returned after a specified period right, as per the terms and conditions. As per the terms and conditions. Clear? So debenture holders are not the owners, they are the creditors of the firm to whom money is to be returned after a specified period as per the terms and conditions set at the time of issue of debentures. Clear? So this is the basics of debentures, right? What are debentures? How we deal with interest? All the terms and conditions are set at the very time at the issue of debentures, right? Now, debenture, if we talk of debenture, this is also known as borrowing, right? Now, majorly our borrowing can be of two types. One is long-term borrowing depending upon duration, okay? Long-term debentures, I can say, and short-term debentures. What does this mean? Long-term debentures and short-term debentures. That means we are taking loan from the public, right? We are taking loan from the public for more than 12 months. That is long-term debentures. This is loan for more than 12 months, right? Short-term debenture is loan for less than 12 months. That means the debentures are issued for a period greater than 12 months, then we consider it as long-term borrowing, and if the debentures are issued for a short period, that is for a period of 12 months or less than 12 months, then it is known as short-term borrowing or short-term debentures. Clear? So on the basis of duration, we have the debentures, which we call it as borrowing also, of two types. One is long-term and the other one is short-term. Long-term means when the money has been taken from the public for a period more than 12 months, and if the money has been raised for a period less than 12 months, these are known as short-term debentures. Now, how we show these long-term and short-term debentures in the balance sheet? That is disclosure in balance sheet. Right? First, talking of long-term debentures. Right? Long-term debentures, if I talk of balance sheet, in the balance sheet I have equity and liabilities as the main head. Under this we have equity share capital that we discussed in the last lecture. Now under this one head we have is non-current liabilities. Now what are non-current liabilities? That means the liabilities which are to be met after 12 months period, right, which are not to be met immediately. These are known as the non-current liabilities. Current liabilities are which we have to pay within a period of 12 months. Non-current liabilities are to be paid in a period more than 12 months, right? So we'll show this long-term debentures in the non-current liabilities. How we show this? First we'll prepare notes to accounts, right? In notes to accounts we have long-term borrowings, right? In the long-term borrowings we will say 9% debentures, 9%, 10,000, 10,000 first. Once again, how you have to write this? 10,000, 9% debentures of rupees 100 each, of rupees 10 each, not 100, I'll take 10 only, of rupees 10 each. What is the amount? 1 lakh rupees. Now how you are going to read this part? That means we have 10,000 debentures on which the interest that has been decided is 9%. You are to raise 1 lakh rupees from the public and you will pay interest at the rate of 9%. This 9% represents the rate of interest. This is rate of interest payable on debentures. Now I told you that this interest rate is always predetermined. So we can write the rate of interest here, 9% debentures of rupees 10 each. Clear? This is how you read this. So 1 lakh rupees is the long-term borrowings. Under the non-current liabilities you will show this head, long-term borrowings. Long-term borrowings of rupees 1 lakh. So this is how you are going to show the debentures as the long-term borrowings in balance sheet under the head equity and liabilities and under the subhead non-current liabilities. There we will take long-term borrowings, and in the notes to accounts in the long-term borrowings we will show how much debentures of what rate. 10,000 debentures of 9%, 10,000 9% debentures of rupees 10 each, right? So this is how you are going to show the long-term debentures in the balance sheet. Now talking of short-term debentures, now if I talk of short-term debentures, that I told you short-term debentures means the money has been raised for a period of less than 12 months. Right? Here the money is raised for a period of more than 12 months. That is why it is kept in non-current liabilities. Right? Now how we are going to show the short-term debentures in the balance sheet? Again, under the head equity and liabilities, right? And subhead this time will be current liabilities. Why current liabilities? Because we have to pay off this liability within a period of 12 months. We have to pay this debenture liability within a period of 12 months. That is why it is known as a current liability. You can write here liability payable within 12 months. Right? Now again what you do, you prepare notes to accounts. Right? In the notes to accounts you will have short-term borrowings. Right, like the long-term borrowings, you will have short-term borrowings, and under the short-term borrowings you will say 10,000 9% debentures of rupees 10 each. That is 1 lakh rupees. Now this short-term borrowings you will show under current liability because these borrowings are to be repaid between a period of 12 months. So short-term borrowings 1 lakh. So this is how you are going to show the short-term debentures in balance sheet. Clear? So this is whole the small concept of debentures. What are debentures? Debentures is the loan that we take from the public. Like it is a loan from bank. Instead of bank, we are taking money from public. And when we are taking the money, we will issue the acknowledgement for that receipt of money. And that acknowledgement is known as issue of debentures, issue of debenture document. Right? And we cannot use the money of public free of cost. We will have to pay interest for using the money of public. That is interest on debentures, right? This interest on debentures is predetermined at the time of issue of debentures. All the terms and conditions relating to repayment of principal amount as well as the payment of interest are decided at the time of issue of debentures. This is very important. Keep it in your mind, right? Then I said that the debenture holders are not the owners of the company. Why? Because we are taking loan from the public and we have to return their money after a specified period. We cannot call them as owners. The owner's money is kept in the business for a long time, like the money taken from shareholders. That money is to be kept in business for a long period of time, but the money that we are raising through the issue of debentures is to be repaid after a specified period as per the terms and conditions set. Right? So debenture holders are the creditors of the firm and not the owners of the firm. Clear? Then according to duration, I told you the debentures can be long-term borrowings and short-term borrowings. Long-term means the money that we have raised for a period of more than 12 months, and short-term is we have to repay that money within 12 months. So then we discussed about disclosures in balance sheet. Clear, friends? So this is what we have discussed, the very basics of debentures. What is a debenture? How it is to be disclosed in the balance sheet? What are the terms and conditions which are set at the time of the issue of debentures? These terms and conditions we will discuss, right, regarding issue and repayment. Clear? So friends, if you have any queries, just send me an email at ksjteaching@gmail.com, right? So in the next lecture, what we are going to discuss is issue of debentures, right? This issue of debentures is exactly similar to what we have done in issue of shares. There is just one additional point in this, nothing else. Absolutely similar. All the journal entries are absolutely similar. We'll discuss it in the next lecture, right? So that's all for this lecture, friends. Thank you so much.